waiting for the reverse mortgage surge. Welcome to the Industry Leader Update. Whatever happened to the mainstreaming of reverse mortgages in retirement plans? That's the question posed in a column by Mark Miller in wealthmanagement.com entitled, Waiting for the Reverse Mortgage Surge. And it is a question worth considering. Since its record endorsement volume in the fiscal year 2009, HECM loan volume shed over 2/3 of its loans by 2020 to rebound slightly last year, thanks to record refinances of existing HECM loans. Now, many pin their hopes that increased acceptance of the reverse mortgage loan amongst financial advisors would help spur industry growth and move the needle on our industry's 2% penetration of eligible households. The pinnacle of HECM loan volume actually arrived following the adoption and the promotion and marketing of the federally insured reverse mortgage by who? Yes, large national banks. And those included Wells Fargo and Bank of America. Now, the value of that distribution channel cannot be overstated. In 7 short years, HECM endorsements surged 778% between the years 2002 and 2009, from 13,000 to nearly 115,000 loans. And then following the housing crash of 2008, Bank of America announced their departure from HECM lending in February 2011, and Wells Fargo followed suit in June of that year. So the sudden departure of the banks was actually attributed to the unprecedented regulatory powers of the then newly created Consumer Financial Protection Bureau, also changes in loan compensation structure and regulation, and reputational risk to the banks as HECM defaults surged and home values plummeted. Ironically, it was against this backdrop that the HECM Saver was brought to the market. This small dollar reverse mortgage offered drastically reduced fees to the consumer for those that were looking to secure a more modest amount of loan proceeds. And while the loan did not bring the anticipated consumer acceptance that many had hoped for, it did bring the HECM into the conversation with many financial advisors for the first time. In April 2012 edition of the Journal of Financial Planning, Harold Avinsky, Sean Pfeiffer, and John Salter introduced the concept of using a reverse mortgage as a way to reduce the hazards of taking retirement distributions while at the same time avoiding a sequence of return risk. While that concept brought some measure of academic acceptance to the federally insured reverse mortgage amongst financial professionals, it did not boost loan acceptance as we had hoped. So when will reverse mortgages go mainstream? Miller's Wealth Management column hints at a couple of ideas that we're seeing some uptick of interest amongst the financial planning community or retirement professionals. Wade Fowle in the column, who is also the professor of retirement income at the American College of Financial Services, says that he has seen some increase in interest amongst registered investment advisors and said this, I think there's at least more willingness to consider when they might have a role in the plan. So you'll see more RIAs using them. Time will tell. Steve Resch, Vice President of Retirement Strategies at Finance of America, expressed frustration at the loan's persistently low market penetration in the column. In a fiduciary environment, you're looking at all sorts of things that might be right for a client. And so how do you look at someone's situation and think, well, home equity could really work well for them, but not mention it to them? And I personally could not agree more. That's akin to a doctor failing to mention a potential cure to help prevent a patient's disease or chronic condition. Now, while the reverse mortgage does remain a robust and very flexible option for retirees to help hedge against financial shocks or even improve their standard of living, its acceptance amongst the American public and financial professionals has a long way to go. Now, share your thoughts on how the reverse mortgage industry could possibly expand its market share. You can do that in the comment section below. And please just take a moment. I kindly ask you to share today's episode on your LinkedIn, Facebook, or Twitter accounts. Today's episode and dozens more, by the way, can be found on YouTube. Just search for HECM World and then subscribe and enable notifications. Also, don't miss this week's podcast episode. We're going to be looking at one research firm that says the home equity release market could triple in the next 10 years. Apple users can listen and subscribe on iTunes. Thank you for joining us and have a great day.